we will be looking at monetary policy that was announced by RBI a couple of days back. So RBI announced a repo rate cut of 25 basis points, which was in line with our expectation. Also, RBI announced significant measures on liquidity easing. In general, there was an expectation that RBI will be working towards improving liquidity. However, the announcements that RBI has eventually delivered are much beyond expectation, and it's a phenomenal change for the entire banking system. Looking at the measures that RBI has announced, is they have announced that they're going to move from current liquidity deficit, which is hovering in the range of 1.5% to 2% of NDTL, and they will be moving this to a neutral level. So what this implies is currently there is a liquidity deficit of 1,60,000 crores. So eventually RBI intends to bring it down to zero, and they intend to do this by way of doing OMOs. Now OMOs is something that RBI has become more aggressive in the last 1 quarter, as they realize that liquidity deficit has been quite large, and that is something which banks as well as corporates were complaining about. So RBI has been trying to address liquidity problem for the last a quarter, and with this monetary policy announcement, they have more or less given a long-term path on improving liquidity. Second announcement that RBI made is on the front of reducing the corridor between the repo, reverse repo and MSF. So earlier it used to stand at 100 basis points. Currently, after the monetary policy announcement, it is reduced to 50 basis points. So what this does is this basically has increased the reverse repo rate by 25 basis points, which will go up to 6%, and it reduces MSF rate by 75 basis points, which will now be standing at 7%. What this clearly implies is again a reasonable benefit for the banks. So repo rate has been reduced by 25 basis points, which means that when banks borrow from RBI, it's going to be at a cheaper rate. Reverse repo has been increased by 25 basis points. What that means is that if banks want to deploy additional funds with RBI, they'll be able to earn higher yields. And the last is MSF. That is the last window which banks approach when there is significant liquidity deficit. The borrowing cost on that front has also been reduced by 75 basis points. So this is another significantly positive measure that has been announced by RBI. Last is there is a CRR balance that banks have to maintain with RBI, which prior to this monetary policy was standing at 95%. Banks were at the moment were also keeping at about 100%, or they were maintaining 100% kind of level. After the policy announcement, that has been brought down to 90%. So that again releases about 20,000 crores worth of funds, which will be available with banks for credit lending. Fourth measure, of course, is in terms of repo rate cut, which all in all will reduce the bond yields. So what we are expecting from these tremendous announcements from RBI is that it will lower the entire yield curve from short term to long term by about 25 to 50 basis points. And effect of that we have already started to see in T-bill auction as well as call rate. Therefore, this eventually should also result in a better transmission by the banks. And as we understand, this entire exercise as well as what government has been trying to do in order to address NPA issues of the banks is towards strengthening the financial system, as well as to improve banking transmission going ahead. So we would anticipate banks to reduce lending rates going ahead more aggressively than they have been doing currently. However, the current problem that we have in hand from the bank's perspective is that deposit rates have the growth in the deposit rates is slowing down. However, credit is picking up. So currently, growth is hovering around 10% for deposits, and for credit it's hovering around 11.5%. So this is one gap which banks would be worried about, and that I believe can work as adversely in terms of transmission going ahead. A last couple of things is in terms of growth. RBI has maintained 7.6% GVA targets for FY17, which is closer to our expectation. There is, upside can come from good monsoon. However, downside risks are there from, slowdown in global economic growth, as well as, input prices going up. Lastly, on inflation, at the moment, RBI has also stated that it is within RBI's comfortable zone. However, they have highlighted concerns on core inflation remaining sticky, and they have also highlighted that 7th pay commission could have reasonably adverse impact on core inflation to the extent of 100 to 150 basis points. Our own understanding of CPI trajectory going ahead is we would expect it to be muted than what RBI has been guiding, primarily towards the impact or from the impact of pay commission on core inflation. So we would expect CPI to come down to a level of 4.5% in the mid of 2016, and therefore we are retaining our expectation of another 25 basis point repo rate cut from RBI sometime in the month of August. So yeah, all in all, we believe it was a phenomenally positive move by RBI, completely unexpected on the liquidity front, and it is a significant medium to long term positive. Thank you so much.